Silicon Valley Bank collapsed in the US, and that's causing global fallout. There's a lot of uncertainty that's entering financial markets. Just be aware, even though the crypto market actually went up in the past 24 hours, that doesn't mean we're through the choppy seas. One thing to understand, this is all happened before. History is repeating itself. The shockwaves of the Silicon Valley Bank collapse are just starting to be felt. Roku, the maker of set-top boxes used for streaming film and television, had 487 million, or about 25% of its cash and cash equivalents, held at the Silicon Valley Bank. It has become a trader's market. Where there's smoke, there's fire. US seeks to stymie bank-run risk as Yellen pledges protections. A lot of people feel that everything is fine. Silicon Valley Bank is going to be auctioned and the government regulators are stepping in. But we need to look back in history, and that's what we're going to do today, to uncover how the global financial crisis actually emerged and what it did to markets. Stay tuned. It's going to be really, really valuable for you to know. Hi everyone, I'm Ken from Crypto Trading KS. I share my 30 plus years in financial markets to assist you to be more of a financial blessing to yourself and those you love, gaining real wealth and positive excellence in the process. We can see in the main markets in the past 24 hours, on the last trading session, there was a massive spike in the VIX. The VIX is the fear gauge of the main markets. We saw a flight out of the US dollar and into bonds, and that bond flight to safety actually sunk bond yields. We saw also a flight into gold. At a time like this, Rule 252 is exceptionally important: prepared and not scared. If you have the knowledge, you can actually utilize this time for your advantage. If you don't have the knowledge, it will be terrifying. In the past trading session, the US market sold down. The entire global banking system runs on a fractional reserve basis. And what does that basically mean? It means that if you go and deposit $1,000 into the bank, that $1,000 is lent out 10 times. That means that the banks do not have the funds to cover deposits. It's a fact that they never have had that capability anyway. A lot of people do not know how the banking system actually operates. For example, if you put in $100 to the bank has to keep reserves, but it can loan out about 90% of that money. Just think about what's actually happening here. You deposit, say $100, $10 is kept as reserves by the bank in case you want your 100 back. Just let that sink in for a second. What happens? The other 90% is loaned out, and of that 90%, 10% is held in deposit, and it's loaned out again and again and again. It's the greatest Ponzi scheme the world has ever known. And it's legal, and it's government backed. This must come as a great shock to a lot of people who don't understand how the banking system works. From today's Sydney Morning Herald, SVB, which did business as Silicon Valley Bank, also had 89% of its $175 billion in deposits uninsured as at the end of 2022. The FDIC insures deposits up to $250,000. To understand banks, you need to understand the fractional reserve system, and fractional reserves means it's a fraction of the reserve. The reserve can't meet deposits. That's why when bank runs occur, banks have to go out of business because they simply can't actually give the funds back. They don't have them. When a bank says that they're insured, for example, FDIC insured, that doesn't mean it's 100%. It means the reserve component. It creates an illusion of some sort of security, but it's really not there. And when we look at the FDIC, it's working on finding a buyer for Silicon Valley Bank. And of course it's looking for a buyer because it can't bail it out. It literally doesn't have the funds to do so. Smart money knows the game and they know what it means, and they need to plug the gaps or else the whole entire system will fall down. Liquidity Group plans a $3 billion emergency loan to aid startups hit by SVB. You'll see a lot of news headlines such as regulators hold auction for Silicon Valley Bank. They need to do this because the FDIC cannot cover deposits. When the majors get hit, there will be a domino effect. Wall Street braces for the next Silicon Valley Bank. And shares of regional banks tumble amid concerns that SVB's collapse is only the beginning. It is. Regulators face the urgent task to stem the spread from Silicon Valley Bank. The next steps could have ripple effects throughout the entire financial system. The Bank of England has actually shut Silicon Valley Bank's UK subsidiary. Silicon Valley Bank is the second largest bank failure in the US. The largest, was Washington Mutual Bank. SVB collapsed when depositors wanted just a fraction of the $209 billion of assets back. They wanted $42 billion back. But the government knows the money is not there because of fractional reserves. You can see the huge amount of uninsured deposits. This is what happens in all banks. Emotions can run high at times like this. It's important that we step back and look from a professional mindset. When we look back to 2008, we can see the market structure of the S&P 500 quite similar to what it is today. But today's market structure is much, much stronger than it was in 2008. What just recently happened with SVB is that we broke down on support. Just remember, this is the global financial crisis unfolding in 2008. Look at how price seeks to come back. This is why I was saying, just because we had a bit of a bounce over the weekend in terms of crypto, and the main market may bounce as well, this doesn't mean this is over. It's really important to understand the price is always moving in a wave. It is officially a trader's market now. If you're investing, the next couple of years could be actually quite problematic. But if you're trading, you will be able to take advantage of so many different opportunities as they present themselves. The thing to note in this particular chart, this is the S&P 500 around June 2008. It broke its support. It came back to try to retest, but it didn't work and it was rejected and started coming down. And when it came down, it really came down. One thing that I would like to point out is that the Lehman Brothers collapse actually occurred right here. See, we're kind of just here if we parallel the global financial crisis to the current price action. What we're actually seeing, SVB is a major bank that's gone down. Silicon Valley Bank was the country's 16th largest bank, but it's now failed. When Lehman Brothers collapsed, it was a $600 billion bankruptcy, the largest bankruptcy in US history. But what did we see with the markets? The markets actually came up in the weeks after that. So it's very important to be aware of these kind of things. But what happened next? The markets got very volatile. They actually lost their technical support, came back for a retest. It's almost like a failed retest here. This was also another failed retest. And the markets started to go down. And they went down and down and down. This volatility is incredibly good for trading, but for investing, it's just heartbreaking. The thing that you need to bear in mind is history looks to be repeating again. I usually do this kind of very in-depth analysis inside the masterclass, but this is very important and people need to know. If we look from where the S&P 500 lost its support, which is kind of about where we are now, just in the starting phases of this, how long did the markets take to bottom out? Was it the next day? Everything just came down? No, it wasn't. It's very important that we look on an apples to apples comparison. We saw that Washington Mutual Bank, which was established in 1889, on its 119th year anniversary, it went bust and became the largest US bank failure. Over its 119-year history, it accumulated 2,239 branches in 15 states and employed over 43,000 employees. It had assets of $307 billion, so you can see this line here on this particular. The question is, are we at point A just here or point B just here? This is a very important question to consider inside your own thinking. Please let me know in the comments, what are your thoughts about this? Now that we have some historical context, we can start talking about the key events that unfolded in the market, and there were a lot of them. Back in 2008, we had Fannie Mae and Freddie Mac. It was all about banks loaning out money to people who could not pay the money back and doing financial manipulation with mortgage-backed securities, hiding the fact that the loans were absolutely and utterly toxic. That means the banks would never get their money back. The markets, the financial markets, are in a much stronger position than 2008 and 2009 at this current time in the banking sector. One thing that we will see is the government will be forced to step in like it was forced to step in with the GFC. Just keep this in mind. We're going to need to look for cascading domino impacts inside the financial market. You can see here, Washington Mutual was closed on the 25th of September in 2008. But you can see there were a lot of Fed policy actions and other policy actions that were occurring around that time. There's a lot of detail here, but needless to say, I'm going to keep my eye, a very watchful eye, on what the government does, what the policymakers do, and the cascading effects that are inevitable now. No stock market can escape the US's gravity. And it's true that all banks all around the world are run on the same fractional reserve system. When the world's largest and strongest economy suffers these problems, other economic systems are suffering them as well. It's important to get your mindset prepared for what could happen next. Do not panic, just prepare, get the knowledge. Keep your eyes on news headlines such as fire sales and government bailouts. In years to come, there will be tens of billions of dollars of fines laid in to punish the banking system, but that's not going to occur right now. Silicon Valley Bank actually collapsed in 48 hours, and a lot of people don't know what the SVB fallout will be. It will be quite severe. We need to prepare ourselves, but we're not scared. How do we prepare ourselves? Well, we need to gain the knowledge. If we're approximately around this particular loss of support, where the current markets are, we can see that the S&P 500 actually bottomed out in 290 days after that. A lot of people hear bad news and they think the markets are going to crater tomorrow. That generally doesn't happen. Even when the markets do crater, they rebound. Crater, rebound. Crater, rebound. That's why it is now officially a trader's market. If we say we're at the point where Washington Mutual Bank failed, that is still 165 days to the bottom. And again, price action was incredibly choppy, up and down, all over the place. This is a trader's market. This is not an investor's market. And the ultimate edge every investor has is the ability to trade. If you're an investor but you can't trade, you're making a mistake because you need to be able to trade. The markets will always turn against you. They turn against everybody. And when they do, trading is the solution. Traders, embrace reality. When you look at the fall in the S&P 500 since the Washington Mutual Bank disaster, its collapse, the S&P 500 came down 45.35% over 162 days. If people were investors, they suffered that loss. Let's compare and contrast this to an actively traded portfolio. Let's look at the same price action in a completely different way through a trader's mindset. We can see that after Washington Mutual was just basically crushed, the markets came down 31.17%, but then they rallied 24.35%. They came down 19%, rallied 19%, came down 26%, rallied 26%, came down nearly 15%, rallied nearly 9%, came down nearly 24%, and then started to rally up. If you're an investor, you're losing money continuously on the way down. If you are a trader, you have the capability of making money, but you need a lot of knowledge to do this. Remember, every investor's superpower is trading. Let's keep this analysis going. So from the bottom, we came down about 24%. The next major rally was up 43.41%. You can already see trading is very, very valuable to learn. Then we look at the next retracement, about 9%. And what is the next rally? It went on for quite a while, up 32.26%. And then a retracement down 9.15%, and then finally around a 17% increase to get back to the original level of the sell-off. What was that? 579 days later, just if you had held on since that fall. Look at all these gains that are on the table: 24%, 19%, 26%, 9%, 43%, 32%, 17%. That is a much, much better proposition than just waiting literally 2 years for your money to come back and break to even. The truth is, it's always a trader's market. Extreme negative volatility actually creates the most incredible trading opportunities. That's why, as traders, we are prepared and not scared. Because traders live in volatility, they have to have a lot of mental models and rules to deal with fear and replace fear with courage. And also how to learn on the fly. Rule 360. Never say should. This is a very good life rule as well. If you say, I should have bought, I should have sold, never, never say should. Why is that? You say, Ken, what do you mean? You never should say should. Should always is the hallmark, the foundation of regret. I should not have sold, which means that you had a crystal ball, you could accurately predict what would happen. And then you just deliberately sold when you knew you could have got more. That is, of course, fantasy. I should have bought is the exact same thing. None of us can see the future. We can only stack probabilities. Please be kind to yourself. Eliminate the word should from your vocabulary. It's a terrible, terrible word. Anxiety, sadness, and even depression rely on the word should. Eliminate should, and happiness will follow. Let's have a look at the S&P 500 now. We can see that we've broken a technical level of support. We can see that that support is not holding up. A lot of people say, okay, the market is just going to crumble. Markets always hit internal, infrastructural demand and supply areas, where smart money is buying and selling. As professional traders and professional investors, we use the CTKS method to mark up our charts. We need to know where the objective dynamic market structure is. We need to know what smart money knows. We need to know and understand where the real support and real resistance is inside the market, where the algorithms will kick in towards either the buy side or the sell side. And what we saw recently was very problematic, and we know exactly why now. Banking contagion and the potential start of the next GFC has cracked all the smart money support levels from the 3848 level upwards. We have one left at around 3700. Just bear this in mind. We've cracked those particular support levels. They will now potentially act as resistance. A lot of people in the crypto market are looking at the market and saying, the stock market doesn't mean anything to us. It's fine. SVB and all the other banks collapsing means nothing. Unfortunately, that's not true. All financial markets are intercorrelated and interconnected. It's good that the crypto market has come up, but it's sold down recently very hard. As crypto is improving right now, a lot of people will be saying things like, people put their money into crypto because banks are unsafe. And it's true, the crypto doesn't have a fractional reserve system. 1 Bitcoin equals 1 Bitcoin. There can never be more than 21 million of them. One thing to bear in mind, Bitcoin is still under resistance. It's currently trading at 21,577. It's fantastic to see this rally for Bitcoin. Bitcoin was grinding its way through all of this smart money sell resistance, and when it broke out, it really went for it because it had a fresh air gap or positive air above it. But just remember, Bitcoin cannot escape the stock market's gravity. If the US markets open and start to dive, Bitcoin will come down with it. Please bear this in mind. Personally, what I've done is to take all my 10-5-10 fund levels out of the market and also liquidated the portfolio, so I'm sitting entirely in cash at the present time. I have literally reset my portfolio. Sitting in cash is a very, very powerful thing to do. We know that there's going to be a lot of incoming volatility. I will simply look at trades on the day from this point onwards. The system could get very, very volatile. If you're sitting on a lot of dry powder, you can make explosive gains when the market is the right direction for you. What I do is not necessarily what you should do. I'm just letting you know what I have actually done. I'm still looking for opportunities inside the crypto market each and every day, but with what is happening across the planet, this will take a little bit of time to play out, so I'm expecting a massive amount of turbulence. When Main Street finally catches on to what is going on, and we are always early, there will be massive volatility incoming. From my personal perspective, I'm not scared at all. I've just reset things. Sometimes it's advisable to do these kinds of actions, but you must make your own actions. Only you can buy and sell, and only you know what's best for you. We're literally at the start of something, but of course we always think in terms of 3 dimensions. We stack the probabilities, and we know that we can control the trade or investment, but it's the market that controls the return. You want to get your synchronization factor up as much as possible. A lot of people say, I don't know where to sell. That's because they're trying to pin the absolute top or the absolute bottom in terms of a buy as well. You only need to make a required rate of return, and that only needs to be better than bank interest, especially if you're doing it each week. I've been in the markets for more than 30 years. I've seen so many sell downs. Everything is pointing towards this getting pretty ugly. I am just taking corrective measures with my money. So what happens if the markets rally and they keep on rallying, they keep on going up? I will participate. What if the markets keep on going down? I will buy effectively, and that's all you need to do. What if the markets flatline and just go wobbly? I'll participate in that as well. It doesn't matter where the markets are going. What actually matters is having enough dry powder to take advantage of it. The markets will tell us if we're here at point A, just under support, or here at point B when things are getting a little bit ugly. Either way, the markets are always moving in a wave. They're always going up and always going down. But one thing you need to do is to sleep soundly at night. Don't forget, you can make money in two ways. You can make profits or you can avoid losses, but we must have courage as our central focus. Remember that this is just literally only happened. It's only been a couple of days. When you have the second largest US bank failure, you need to pay attention. This is not just news that you should gloss over. We always bear Rule 252 in mind, prepared and not scared. There's no fear at all about what the markets could do. Go up or down is irrelevant to us. We know the price is always moving in a wave. We just want to prepare ourselves to participate in that action. You don't prepare yourself to sit on the sidelines. You prepare yourself to go into the thick of it, just like a firefighter entering a burning building. That's what we're famous for as a community. One thing to always avoid is the panic zone and the blame zone. We are in control of our lives. What we do inside Zone 3 and Zone 4, we stack probabilities. The probabilities at the moment are for systemic problems. We want to get on the right side of the percentage, and we're prepared and not scared. We're not concerned. Fear doesn't guide our behavior. Preparation does, and courage. It's a completely different way to look at the market. As professionals, we put money last and we put the strategy and the process first. We're always learning and we're adaptive. We're not set in our ways. We can change in a heartbeat. If the market throws new information at us and it's significant information, we're going to act on that information, no matter what our position was in the past 24 hours. Each and every day, we need to keep very, very positive, because when you change your thoughts, you change your life. The thoughts we think are thoughts of courage and all the components of positive excellence. We do this through the CTKS Creed, daily positive affirmations for abundance, financial success, and happiness. Life doesn't happen to you, it happens for you, because you know that the universe is designed to make you succeed. No matter what hardships we go through, and everybody has a burden to carry, every day you show kindness, integrity, and gratitude. The darkness today doesn't mean the sun won't come out this afternoon, so you know opportunities and life reset every single day. The most important thing is that you know you're worthy of every success in this world, and you just go slow to go fast. Don't be in a hurry. Being in a hurry is like thinking that life is a sprint. It's not a sprint, it's a marathon. Most people want to make it big as quickly as possible, and those people go up in flames typically. So therefore, be smart. Start small and scale. Life is always redirecting us, and we get our share of heartache and heartbreak. We also get our shares of sickness and just bad luck. But you know one thing, life pullbacks give you the strength for the next life rally. Life, just like price, is moving in a wave. You may have a retracement, but that's setting you up for the next life rally. I believe the most important lines in the CTKS Creed, these daily positive affirmations that you say, so the I is about you. It's not about me, it's about you. I am dedicated and committed. I win or learn and never blame. I always solve my problems with positive excellence. I believe those words have life transformation capability inside them. We know that all results come from the mind, and better habits create a better mind and better outcomes. All you need are better habits, and the life you have always dreamt of will be yours. Life takes time to play out, like price takes time to play out in the markets. Just always be prepared, and do not be scared. I hope you've enjoyed this special episode, and Kate and I look forward to catching up with you tomorrow. Bye for now.